Hello, my dear friends, and welcome back to Boss Economics World. Today, we're diving deep into the so-called blockbuster jobs report from September that everyone's been raving about in the financial media. If you believe what they say, the U.S. economy is doing better than anyone could have imagined. The numbers from the Bureau of Labor Statistics show that employers added a whopping 254,000 jobs in September, way above expectations. The unemployment rate fell to 4.1%, down from 4.3% just a couple of months ago, and wage gains outpaced inflation. But, just as the numbers look so sunny and rosy, it's time to sharpen your skepticism and dig into what these figures really tell us. First off, let's not be so quick to throw confetti. Here's what the mainstream headlines won't tell you. Those blockbuster payroll gains? More than half of the job additions were confined to just two sectors, leisure and hospitality and healthcare. So, while it's great that bartenders and nurses are getting hired, what about all the other sectors in the economy? Have we forgotten this isn't a hospitality economy? Why aren't we seeing more broad-based employment gains in areas like manufacturing or technology? If anything, this uneven distribution indicates underlying weaknesses that could pose major problems down the road. What I see could be the rumblings of a structural problem, and not the strong economy that the Fed wants you to believe. So let's go through this report from the angle that no one else is talking about. Yes, the report says jobs are being added, but if you're truly paying attention, you'll see that the majority of these new jobs are low-wage. Have you ever noticed how jobs in areas such as leisure and hospitality consistently lead the pack? This is fantastic if you need a bartender, but it begs the question. Are these jobs the backbone of a 21st century economy? The technology sector, manufacturing, finance, and even construction, where the high-paying middle-class jobs that drive economic growth are found, are miles behind. Let's be real, folks. Creating jobs is one thing, but creating quality jobs is another. Sure, there are bodies behind cash registers and serving at tables, but these positions don't come with the income stability, benefits, or long-term security that build wealth and drive sustainable consumption. Take a look at the wage gains, another area of supposed good news. Wages outpaced inflation for now, but it's crucial to dissect where and how. Averages tell you nothing when high-wage sectors are stagnant, but low-wage sectors rise, skewing the average upward. People across the board are not stepping into better-paying jobs, just more jobs that keep them on the edge. And should we be celebrating this muted response to inflation? There's a risk that wage growth will pressure core inflation upward, especially when wage increases aren't fueling any productivity gains. As inflation retreats, wage gains shouldn't be mistaken as a long-term victory. They may only fuel future price hikes down the line. Now, let's talk about the real shocker here. We are still hovering on the cliff's edge of inflation. Sure, inflation has dropped from a high of 9.1% in 2022, but we're not out of the woods by any means. The recent wage growth, coupled with fewer productivity gains, might just stoke the embers of inflation once more. The more wages rise without accompanying productivity surges, the more businesses will pass these costs on to consumers. That means the risk of re-accelerating inflation becomes very real. Let's roll back the clock a bit and remember an old lesson from the pandemic days. After all the trillions poured into the economy, inflation surged to the highest levels we've seen in decades. Fast forward to now, and the Fed's 2% inflation goal seems wishful thinking. Think of it like a yo-yo. Sometimes it looks like it's going down, but when the wage price mechanics kick in, expect it to swing right back up. Some experts, including Drew Mattis and Derek Tang, have warned that the Fed's next move might be the one to watch. Moderate voices are saying 25 basis points, but any sign of inflation roaring back suggests a potential overreaction like we saw with the rapid rate hikes last year. Let's switch gears and talk about the Federal Reserve's role in all of this. Jerome Powell, chair of the Federal Reserve, has been on quite a roller coaster these past months. The half-point rate cut in September, which many saw as a bold move, seems to be a warning signal for the major players in the economy. Sure, with rising employment and inflation cooling off, it appears the Fed might feel comfortable scaling back its aggressive rate cuts. But this is where the Fed always has to walk a tightrope. Let's say the great hiring spree in leisure and hospitality ends up fizzling out in the coming months as consumer confidence retreats. It's not impossible to imagine a situation where Powell's moves find themselves rapidly outdated. Former Treasury Secretary Lawrence Summers, who's never shy about calling out the Fed, already suggested that the 50 basis point cut in September might have been a mistake. Now, luckily, he doesn't think this misstep will have catastrophic consequences, but it signs a warning nonetheless. A sharp bob-and-weave reaction from the Fed could just as easily expose new vulnerabilities. And to my followers in the finance world, you know just how much the Fed's decisions ripple across the bond market. High interest rates may be keeping inflation under control for now, but they're also putting insane pressure on certain borrowing sectors, risking creating bubbles or reverse compressions in particularly sensitive industries. Think real estate, bonds, corporate debts. What happens when corporate debt defaults become a regular occurrence? Or when the housing market seizes up? The Fed might neutralize inflation, but at a heavy cost to an already fragile economy on other fronts. You will often hear central bankers, especially those with more dovish inclinations, talk about the prospects of a soft landing. What they mean by soft landing is that the Fed can guide the economy through the complicated task of tightening monetary policy to fight inflation without triggering a major recession. But let's be clear here. A soft landing isn't guaranteed, even with the best intentions, and might I add, it has a shaky record historically. The idea keeps getting floated rhetorically because what else can central bankers say? They're in a difficult position with elevated debt, a slowing global economy, and a growing divergence between different sectors within the U.S. economy. Policymakers are watching a real-time tightrope act as they try to balance cutting rates without reigniting inflation. As much as we want to believe the economy can skate by without some side effects, data from Europe, South America, and Asia tells us one thing. Recessions often happen when and where central bankers least expect them. Despite all the job growth talk, you want to keep any eye on the underemployed and those at the margins of the labor force. According to Bureau of Labor Statistics figures, there's a troubling rise in discouraged workers and unemployment long-term spells. These figures look insignificant when buried in an otherwise positive report, but don't be fooled. The longer these trends persist amongst certain groups like women of color, young people, or those without specialized skills, the harder they'll be to reverse. When these workers remain sidelined, economic scarring sets in. Long-term unemployment leads to lower labor force participation down the road, meaning the potential growth rate of the economy starts shrinking. And that's bad news for extension programs, retirement accounts, pensions, and future earning potential for millions of Americans. Oh, and let's not forget the global externalities here, folks. While the Fed adjusts monetary policy based on domestic data, the entire world is watching. As U.S. rates fluctuate, emerging markets will feel the whiplash, leading to capital flight, currency devaluation in some regions, and real consequences in terms of jobs and growth for countries tied closely to U.S. economic performance. A tighter U.S. market with firmer rates pushes money into U.S. assets, weakening weaker economies. China's economic woes compound, with the real estate crisis hitting hard, and Europe remains bogged down by the grim effects of the Ukraine war and its own nagging inflation problems. You think we're immune? Think again. Global headwinds have a nasty way of circling back home. To summarize, this jobs report isn't quite the buoyant indicator mainstream economists may want you to believe. Strong headline numbers mask weaknesses underneath. The Fed finds itself in a uniquely precarious position as inflation, labor market volatility, and wage dynamics all entangle, and without major corrective action or global coordination, complacency today will be tomorrow's mess. To the average American worker, wage growth isn't the victory they think it is. Eventually, it could feed even higher inflation. To the finance professionals tuning in, heed the warning signs in global capital flows and tightening liquidity. That resilience the media touts could very easily be the calm before the storm. The market exuberance we've seen from investors betting on the Fed's tentative cuts could evaporate just as quickly. And when it does, brace yourself for a wave of correction that could ripple across industries and geographies. The warning bells are already ringing. Are we listening? Now, as your always skeptical host, I want you to ponder this. If the recovery is really that strong, why are we still seeing so much concern about persistent inflation risk? And why is wage growth concentrated only in low-wage sectors? When leisure and hospitality add jobs by the boatload, but technology, manufacturing, and skilled industries are stagnating, it sets off alarm bells for anyone paying attention. Half of September's job gains came from leisure and healthcare, two sectors that don't necessarily represent the broader economy's health. This creates a superficial sheen of recovery, while the deeper foundation could still potentially crumble. Look at corporate investments. Companies aren't exactly rushing out to hire in droves in high-growth, high-productivity sectors. They're cautious. Why? Because business investments dry up in a shaky macroeconomic environment, especially when the Fed is indecisive about future rate cuts. When business leaders don't know where interest rates will end up, they become hesitant to invest in future productivity, which results in sluggish GDP growth. This brings us to another sore point. GDP numbers may hold up for a little while, but don't forget that GDP is a lagging indicator. The real economic pain might not reveal itself until next year or beyond. While the Fed adjusts its interest rate tools with a very delicate hand, structural weaknesses in global trade, corporate borrowing, and consumer demand are being masked by the short-term sugar high of Fed policy changes. Let me make something clear. We are not immune to a recession. The United States cannot wishcast itself into prosperity when the underlying warning signs are so glaring. Speaking honestly, many of you that tune into my channel or read between the lines of mainstream media know that the fundamentals are shaky. A quick glance at the consumer spending numbers, which are slowly showing signs of wobbling, or the mounting consumer debt levels should give anyone pause. Now here's the real kicker. Jerome Powell and the Fed can't keep waving their magic wand forever. This easing of rates might feel good now, but it's essentially kicking the can down the road. Look at it this way. For every rate cut that temporarily boosts job creation, there's a borrowing sector, be it corporate debt or mortgages, waiting for the impact of swollen assets to hit them. Keep in mind that post-recession recoveries, when propped up by easy money for too long, tend to front-load the pain to future years. Borrowing becomes cheap again, bubbles inflate, and suddenly, without realizing it, you've built a fragile house of cards. Do we really want a repeat of 2007 to 2008? We can't talk about what's happening in the labor market without touching upon the corporate debt bubble simmering underneath this so-called strong jobs report. If you've been paying attention, you'll know that U.S. corporate debt hit $10.5 trillion in 2023, according to the Securities Industry and Financial Markets Association, SIFMA. That's right, corporations are more indebted than ever, and the debt-to-GDP ratio suggests we're tipping into dangerous territory. The more rates stay relatively low, the more debt these companies will take on, especially to keep funding stock buybacks rather than genuine investments in new technologies, higher productivity, or capital projects. This creates a dangerous domino effect. Markets are still feverishly buying U.S. corporate bonds, hungry for yields, and long-term bond yields have steadily inched higher over the past few months. All this will eventually pressure balance sheets, leaving companies vulnerable to rising debt servicing costs should the Fed pivot faster than expected, or if credit tightening becomes inevitable. When the cracks finally show in corporate balance sheets, expect massive layoffs and corporate defaults, and unemployment could rapidly spike again. There's a reservoir of risk here, and the market's current complacency is deeply troubling. Remember, folks, rising corporate debt can transform a jobs report victory into a recession defeat overnight. If businesses face a credit crunch and can't meet their obligations, those rosy employment gains can vanish in an instant. For years, economists have debated whether or not wage growth is unequivocally good news. Yes, higher wages can lift consumer spending power and generate short-term confidence, but here's what most mainstream economists downplay. Wage growth without corresponding productivity increases can actually choke the economy in the long run. When wage increases get passed on to consumers via higher prices, you contribute to the cyclical problem of cost-push inflation, where businesses raise prices to cover higher labor costs, especially in low-productivity areas like leisure and hospitality. This doesn't lead to better standards of living because real wages become stagnant under upward price pressure. It's a vicious cycle. Wage hikes lead to price hikes. The Fed cuts rates to stimulate consumption, which then fuels inflation again. This is exactly the kind of inflationary spiral that many skeptics fear the U.S. is tiptoeing toward. It's a tricky balance. Giving workers higher wages seems fair, especially after so many years of stagnant pay. But when this happens in low productivity sectors, as we've discussed, the economy finds itself on a dangerous precipice. Without meaningful productivity improvements, these additional costs get passed back to everyday Americans in the form of inflation, eroding the very wage gains policymakers boast about. Naturally, people might feel good in the short term, they've got more income after all. But wait till those price hikes punch them in their wallets. Suddenly that extra pay doesn't go as far as they thought because now it costs more to live. If energy prices rise, food prices rise, and rent ticks up, Even nominal wage gains won't protect Americans from losing in real terms. As if the challenges at home weren't enough, the global economy is showing clear signs of deceleration, and this could end up curbing the U.S. recovery far more than many anticipate. Take a look at China's economic slowdown, for instance. The world's second-largest economy has been struggling with the collapse of its real estate sector, a critical pillar of its economic model. With the ongoing Evergrande crisis, it's clear China's property bubble has burst, and we're only now starting to see the ripple effects on global markets. For years, China was a key driver of global growth through its demand for raw materials, commodities, and luxury goods. Now that demand is diminishing, leaving a gap that emerging economies and Europe are struggling to fill. The European Union itself is grappling with stagnation and persistent inflation, exacerbated by the ongoing war in Ukraine and skyrocketing energy prices. Does the Fed really think the U.S. economy is immune from these external forces? Of course not. In fact, with China's slowdown and Europe teetering on recession, U.S. exports are starting to feel the pressure. Already we've seen a substantial slowdown in trade and industrial output due to declining global demand. Global supply chain disruptions haven't fully ironed out either. Shipping costs are starting to creep back upwards, and the risks of geopolitical flare-ups in key regions like Taiwan or between Russia and NATO still loom on the horizon. Any of these upheavals could derail a so-called soft landing in a heartbeat. The interconnectedness of the global economy means that domestic decisions, particularly around interest rates and monetary policy, aren't made in a vacuum. The ripple effects of U.S. policy changes are felt worldwide, particularly in emerging markets. If the Fed continues to cut rates too aggressively, it could lead to massive capital outflows from some of these emerging economies, leaving them high and dry, without the necessary investment to fuel real growth. So what's the takeaway here, folks? The Fed's gradual easing of rates has created a superficial sense of relief, but beneath the surface, multiple ticking time bombs, corporate debt, wage inflation mismatches, global recessionary pressures, are just waiting for their cue. September's job report may look good on the surface, but strong numbers in certain pockets of the economy hide a deeper fragility. We are not quite nearing a breakdown, but the wheels are certainly wobbly. The probability of executing this magical soft landing, where the Fed can delicately ease inflation, sustain job growth, and rejuvenate productivity without triggering a recession, seems less like rational economic planning and more like a risky bet. The last thing the Fed can afford is complacency or premature celebration. For my professionals out there in finance, you know the drill. Keep watching those bond yields, especially on long-dated treasuries. To the everyday workers and small business owners out there, be cautious. Saving, investing wisely, and preserving liquidity could be the keys to weathering what's looking more and more like the beginning of a storm. So what will it be? Another tempting round of rate cuts to appease short-term markets, or the necessary discipline to avoid digging ourselves into a deeper hole? Only time will tell. But do not say I didn't warn you.